Financial leverage, what it is, and how to use it wisely to boost your investments. Financial leverage is a strategy used in both traditional and cryptocurrency markets that allows investors to multiply their buying or investment power without needing the total capital. In simple terms, leverage enables you to invest more money than you have by borrowing additional capital from a third party, usually a broker or investment platform. This technique can be very attractive because it amplifies potential gains, but it also increases the risk of losses, so it's crucial to understand how it works and use it prudently. 1. What is financial leverage? Financial leverage is the use of borrowed capital to increase an individual or company's investment position in an asset. In the context of investment, leverage allows investors to take larger positions than they could with their own capital. This translates into greater potential profits, but also significant losses if the market moves against them. For example, 2:1 leverage means the investor can invest twice their initial capital. If someone has $1,000 and applies 2:1 leverage, they can control a $2,000 position. However, if the investment's value drops, losses multiply in the same proportion, risking not only the initial capital, but also the borrowed money. 2. Types of financial leverage and how they work. There are various types of financial leverage, but the most common in financial markets include margin leverage, typically used in stock and cryptocurrency investments. This involves borrowing from the broker to increase the investment position. This is done through a margin account, which allows the investor to borrow against the value of their assets. Leverage and derivatives. Financial derivatives, such as options and futures, allow investors to take leveraged positions without needing to borrow capital. In these cases, the investor only pays a fraction of the asset's value, known as the initial margin, but can profit or lose based on the asset's full value. Cryptocurrency leverage. Cryptocurrency exchanges allow leverage to increase position values in cryptocurrencies. However, the inherent volatility of cryptocurrencies makes this type of leverage especially risky, as price fluctuations can lead to rapid losses. 3. Advantages of using financial leverage. Greater market exposure. One of the main advantages is that you can have significantly more market exposure than if you only used your own capital. This allows investors to capture potential gains on a larger scale without committing all their funds. Potential for higher profits. If the market moves in your favor, profits are amplified proportionally. This can be especially useful for experienced traders who know the market and have strategies to minimize risks. Capital diversification. By using leverage, an investor can distribute their capital across multiple investments simultaneously, taking advantage of various market opportunities without locking up large amounts of money in a single trade. 4. Risks associated with financial leverage. Despite its benefits, financial leverage carries considerable risks that should not be underestimated. Multiplication of losses. Just as gains can be multiplied, so can losses. In the worst case, an investor could lose more than their initial capital, ending up in debt to the lender or broker. Volatility and maintenance margin. In leveraged trades, especially in volatile markets like cryptocurrencies, brokers require a maintenance margin. If the investment falls below this margin, the broker may demand additional funds or even close the position to avoid further losses, causing forced losses. Emotional effect. The pressure of trading with borrowed money can lead to impulsive, risky decisions. The possibility of losing borrowed capital increases stress and may lead to poor decisions under pressure. 5. Tips for using leverage safely. Evaluate your risk tolerance. Before using leverage, be sure you understand your ability to take on risks. If you're a conservative investor, leverage may not be suitable for you. Use low leverage ratios. The higher the leverage, the greater the risk. For beginners, it's recommended to start with low leverage, 2:1 or 3:1, until gaining experience in managing leveraged positions. Set stop-loss limits. Use stop-loss orders to protect your capital if the market moves against you. This ensures that, if the trade turns unfavorable, your losses won't exceed a predefined limit. Check market conditions. Avoid using leverage in highly volatile markets, such as when important announcements or economic reports are released. Extreme volatility can cause leveraged positions to lead to substantial losses. Operate with a clear strategy. Don't enter leveraged positions without a well-defined trading plan. Knowing entry levels, profit targets, and exit levels before trading helps maintain investment control. 6. When financial leverage is a good option. There are certain scenarios where using leverage can be a suitable strategy. Bull markets. If market analysis suggests a sustained upward trend, leverage allows you to maximize profits in a favorable market. For example, if indicators show a likely rise in an asset, leverage could help obtain greater returns. Short-term trades. For experienced traders, leverage is ideal in fast trades where small market movements are targeted. Traders can benefit from intraday volatility without committing large amounts of capital. Hedging. Some investors use leverage to hedge other positions. For example, in a down market, a trader could use leverage in short positions, short sales, to offset losses in other assets in their portfolio.